there is no specific hard and fast rule on how LLC owners should pay themselves. But there are some guidelines for sure, and I'm going to give those to you tonight. And there are some IRS stipulations once you make certain moves to start paying yourself. All right, all right. Welcome, welcome, welcome to another session of Tax Life. And I am your host, Jeffrey White, 30 plus year tax strategist and business strategist, business owner, business coach, um, husband, father, military veteran. And I appreciate you being here, supporting me, getting some really, really valuable information and trying to live the tax life, all right, or live a tax life. So tonight's session is super exciting to me because I do a lot of small businesses. I do a lot of LLC uh, tax preparation, LLC setup, and this question or this concern about how LLC owners pay themselves it comes to me across my desk all the time. And so I thought it'd be a good topic, and I want to address it, but I want to address it in a real uh, tax smart, tax life way. Okay. So welcome everybody to this session. How LLC owners pay themselves tax smart. All right. So I'm glad you're here because again, like I said, this concern from LLC owners comes up all the time. And it's really super important. But there is no specific hard and fast rule on how LLC owners should pay themselves. But there are some guidelines for sure, and I'm going to give those to you tonight. And there are some IRS stipulations once you make certain moves to start paying yourself. All right. So the first question is, how do you pay yourself tax smart? All right. What does that look like? I get questions all the time. Uh, should I transfer money from my business account to my personal account? Or when should I do it? Or should I be on payroll? Or when should I be on payroll? Or is it time for me to start thinking about? I've heard about this thing called a S-Corporation, and I get these questions all the time. This is what we do in our offices year round, actually. And if any of those questions have ever come into your mind or someone you know, then stick around because I'm going to break it all down to you step by step and give you my tax smart way of LLCs going to pay themselves. All right. So before we jump in, I want to hear from you. Let me know you're out there. I know that I've got some supporters. You guys have told me so when I've talked to you on the phone or talked to you on video, and I appreciate that. I really do. So here's what we're going to cover in our lesson today. We're going to talk about the three main ways that LLC owners pay themselves. Okay, we're going to talk about the consequences of those three ways, each way, and then we're going to talk about some of the mistakes that I see LLC owners make every year and how to avoid those mistakes. Then, as usual, we're going to talk about our immutable law and some principles that go with it. And then finally, we're going to talk about a tax smart framework to help you, if you're an LLC owner, decide the right way to pay yourself. Okay. And then, as always, I'm going to give some practical tips that you can start using today in your tax life. All right. So let's talk about the LLC to begin with, limited liability company. Okay. I want to clear up a huge misconception, and it's not anyone's fault, but there's not a whole lot of training on LLCs. But an LLC is actually a legal structure. Okay, it's not a tax classification, say like corporation or partnership. So the IRS doesn't recognize the LLC as a tax form. Okay, what the IRS does though is they look at how many people are involved in your business, even if it is an LLC, and most LLCs are set up at the state level, whereas the IRS is at the federal level. But the IRS will look at how many individuals are in your business, and then they will assign a default classification. Okay, and um, that's really really important. So if you're an LLC owner and you are trying to make sure you're paying yourself properly, okay, then you want to have some guidelines, all right? And the IRS is going to make a classification once you let them know that you have set up your business and you have the legal structure of an LLC. Then they're going to offer you, or they're going to assign you, I should say, a tax structure or a tax classification. Okay, if you're a sole owner, then you're going to be classified as a sole proprietor. You'll fill out Schedule C. If there are multiple owners in your business, then you're going to be classified as a partnership, okay, for tax purposes, and you're going to fill out a form, or you should fill out a form 1065. Um, and then obviously, if you're at a point in time where your business is changing, or you go from sole proprietor and you want to start receiving some different benefits, then you can actually elect a classification of an S corporation or a C corporation. You fill out the proper paperwork. The IRS says yes or no, and then now you're still an LLC, but you're from a legal standpoint, you're still an LLC. You still got all the legal protections of an LLC, but you're taxed as an S corporation or a C corporation. Okay. Now the cool thing about this is the flexibility is powerful. Okay, and you now are starting to see and have the ability to affect your tax life in your business. Okay, but with flexibility comes certain level of responsibility. Okay, and at points in your business life, the business life cycle, you're going to have to actually decide when to pay yourself, and that's what I'm here for. So that's where a lot of confusion comes in. So if you're already an LLC owner and business owner, and you're a single member, one person, then put a one in the chat. If you have an LLC that is classified for tax purposes as a 1065 partnership, then put a two in the chat and just let me know you're out there and what your classification is. Okay. So let's talk about the three ways that you as an LLC owner should pay yourself or can pay yourself, right? And the first and most common way is to take what's called the owner's draw, or you may hear it called sometimes a distribution, okay? And this is where you, the business owner, just basically takes money out of your business's account and transfers that money into your personal account, okay? Here's a quick tip though. Before you decide to pay yourself as a business owner, and let's say it's your beginning years of your startup LLC, make sure the business is properly funded first before you pay yourself. I've been in this game for over 30 years, and I see a lot of people, they have a great idea, they start their business, they operate their business, they're on money mode, revenue mode from day one, but they're also needing to sustain their lifestyle, and they start pulling money out of the business operations, in my estimation, too soon and too haphazardly. Okay, so make sure that you have your business funded properly before you start pulling money out to pay yourself. And when I mean business funded, basically you need to be able to pay your operating expenses, have some cash reserves set aside for a rainy day, because rainy days do come. I can tell you this from firsthand knowledge. It was close to 35 years ago. I used to own a trucking business in a partnership with a really close friend of mine from college, and we were doing really well, successful, making money. I had already graduated from college, but I wanted to be a business owner. So we went out there and we started working and driving and learning how to drive tractor trailers and trucks. We had a business. It was my impatientness impatience, I guess, that decided to get another truck, and it was too soon, and we weren't ready, and we were spending money hand over fist, and eventually one of the trucks broke down, as trucks do. They break down, and the cost of fixing it was astronomical. We didn't have it because we didn't have our emergency funds set aside or cash reserves. So if there's a bit of advice I can give in this particular session, yeah, make sure you got your cash reserve, your operating expenses, money set aside to pay taxes before you start paying yourself, okay? Then you pay yourself and make sure the business can support itself, all right? Remember, even if you don't draw every dollar or distribute every dollar to yourself or to your business partners, the IRS is still going to tax the profit of the LLC, okay? So I want you to think of that. Okay, they're still going to profit. They're still going to tax the profit of the LLC. I want you to think of that as like a lemon tree. All right, and I had a lemon tree growing up as a kid, and my job in the summertime, especially, was to crawl up that tree and get lemons from my mom and my sister. So we had lemonade all summer. But I want you to think of this situation in the tax realm as your lemon tree, and the IRS takes the lemons that grow on the whole tree, not just the ones that you pick. Okay, so you're going to be taxed on money that is the profit of the company, not just the profit that you take as a distribution or the revenue that you take as a distribution. Okay, so keep that in mind. And the key thing here is have money set aside for your operating expenses, cash reserves, pay taxes, and a feeling of peace and peace of mind that your business will be standing on firm ground, not shaky ground. All right. So the next way that LLC owners pay themselves tax smart is through salary. Okay. They can, and you can pay yourself a salary under the right circumstances, but paying yourself a salary will require a payroll. Okay. So when you decide that you want to go that route, okay, if your LLC is taxed as an S corporation, or you have a partnership that's a multi-member LLC that gets guaranteed payments, then you're going to be looking to pay yourself a salary. And with a salary comes payroll. But here's another tip. All right. When you choose a salary, make sure that the salary is commensurate or makes sense for what you're doing and is in within the IRS guidelines. And the IRS says that what you pay yourself has to be um, has to be commiserate with what the standards are for what you do, the time you spent, your role, the industry that the business is in. All right. Now, if you pay yourself too little, the IRS comes knocking. If you pay yourself too much, then you lose a lot of tax advantages. Okay. So you want to look for that sweet spot for the role that you have in the company. You're going to look for that sweet spot to pay yourself how much time you spend in that enterprise, because the business could be a full-time business or a side hustle. You want to look at what other people who have that same type of business and spend the same amount of time are paying themselves. You have to look at a few variables in order to decide and determine what is the proper salary for you in your company, okay? Going to tell you another tip here. Don't rush to pay yourself payroll. Wait until your business and income is somewhat um, determinable, if that's the right word. It's somewhat able to be determined to be stable. Okay, you don't want to start putting yourself on payroll and your income is fluctuating too much. Okay. Once you can determine that your business is moving in a positive direction and that you can kind of look at your cash flows week to week, month to month, then you need to start determining, okay, I believe that I can go on payroll, and you don't start yourself on payroll at some really really astronomical amount. You start yourself small, and then you incrementally work your way up as your revenues grow. Okay. Here's the thing: you don't want to rush into payroll until your business is ready and steady. Okay, because with payroll there are costs involved. Okay, you have to pay payroll taxes, you have to pay uh, income taxes, you have to file tax returns, you have to pay for the payroll service, you may even have to pay a bookkeeper. So if your profits are too small, then it's probably not worth the burden or the headache to start payroll too soon. All right. Now, the next method that LLC owners use to pay themselves tax smart is they remember earlier in the session I said that you have flexibility because at certain points in time in the growth of your organization, you have the ability to ask the IRS to change your classification. Okay. Remember, the LLC is the legal structure. Okay. The the classification of your business from a tax standpoint is determined by the number of people in your business and then what the IRS default is for that number of persons. So, but at some point in time, when your business is starting to grow and earn profit, it might be a good idea to start looking to move your classification that you're in to a classification called an S corporation. Okay. And when you do that, you have then the ability, because you are um, a business owner, you have the ability to take and do what's called a split strategy or a split income strategy. Okay. And when you ask the IRS to treat you now as an S corporation, okay, versus a sole proprietor or a partnership, now you can take some of your income as a salary, and then a portion, and then the income that you take as a salary will be subject um, to taxation, all right, and payroll taxes. But then you have the ability to take the rest of your income, let's say a portion, as a draw or a distribution, which those that income is not subject to self-employment taxes. Okay, that's really really powerful. Okay, because it gives you the ability to control your income and use tax planning as a way to create tax savings. Okay, I'll give you an example. Right, let's say you started your business, you're doing really well, and your business profit is $120,000. Okay, when you make the election to ask, well, you ask the IRS to change your classification, let's say from a sole proprietor to an S corporation with one sole investor and one sole owner. Okay, then you have the ability to now ask the IRS, hey, I want to change that classification to an S corporation. Okay, now you have to pay yourself a reasonable salary. Okay, and you can actually split that money, that $120,000. So now you don't actually have to have it all taxed at that 120 level and be subject to self-employment tax. You can take half of it, maybe that's 60,000, okay, and then the other half as distribution. And this splitting of the income can save you thousands and thousands of dollars, okay? But here's a word of caution. All right, it's always, you got to always think this thing through, and you have to be strategic. Okay, just because a strategy is available to you doesn't mean you automatically take it. The word of caution means you don't want to automatically go into selection or election of being an S corporation too early. All right, it's a good idea to wait, and you want to wait until you start making profit in your entity, and your profit should be anywhere between 40,000 and 60,000. Okay, that's a good time to start to explore the option of moving your classification. Okay, otherwise, the cost of payroll and the tax filings and the bookkeeping and all those things can sometimes just wipe out the tax savings. Okay, so you have to be very, very judicious, very, very strategic. And as a matter of fact, it's probably the best thing is when you get to that point, you know what, even before that, you need to start looking into getting the advice of someone that is well versed, not just in tax preparation, but in the planning of your taxes and in the strategic planning of your taxes, and even someone that is involved intimately that knows business as well, that can give you some really good advice on the timing of that election. Okay. So now I want to talk about some mistakes that I see in LLC owners when they decide to pay themselves, or how they decide to pay themselves, or even what they decide to pay themselves. Okay, there are five mistakes that I want to point out, and these are five mistakes that I have seen over the years that LLC owners make. They make these mistakes for a number of reasons, but they can be very costly if they do not think things through. Okay, hold on one second. So the five mistakes that I see when it comes to LLC owners paying themselves. First one is paying yourself whenever you feel like it. All right, with no structure. You would be, well, you probably won't be surprised. And in my, again, 30 plus years, um, I've seen this happen over and over and over again. And even in one of my businesses, like I said, the pain of yourself in an unstructured manner whenever you feel like it can actually put you in jeopardy as a business owner. Okay, because when you do that, you put your cash flow in jeopardy, and you tighten your cash flow and you restrict your cash flow, and at some point in time, you're gonna need cash in the event, like I told you in my business, when our truck went down, we did not have the cash available to get it fixed right away. And that was the beginning of the end for me in that particular business. But I learned a valuable lesson. Okay. So yeah, I see this all the time. I did it myself. Paying yourself whenever you feel like it without any structure. Just a no. Okay. Mixing business funds or business accounts with personal accounts. 100% no. Okay. And in tax planning, when we approach our clients and we start the process of implementing their tax plan, we make it plain and real simple that this is one of the things the IRS really um, concerns themselves with, and really looks into: is there a commingling of funds from the business to the personal? And in some cases, I've got clients that don't even have a business account. Okay, so they don't even have a business account to commingle. Okay, and everything works through their personal account. And initially, you may need to, obviously, most people, they fund their business from personal funds. Okay, personal funds that they have, or personal funds that they may have gotten from investors. But at some point in time, when your business is set up, and in our cases, when we set up our tax planning clients in their first initial business, it's very, very shortly after the LLC formation is fully registered, and they have their employer identification number, or EIN number, and they have their certificate of organization and their articles of organization. Hey, you take those three documents and you go directly to the bank and you set up a business account. Okay. But yeah, I've seen it all too often: the commingling and the mixing of personal revenue and personal funds with business funds. No. Okay. Another thing I've seen, number 3, electing an S corporation too early, like I stated before. Okay, some of the costs involved of setting up an S corporation and getting it going and erodes at your tax savings. It makes no sense that you set up the you set up the S corporation. You have to do all the things that are required by the IRS, a board of advisors, meetings, and things like that have to be recorded, and documents that have to be um, received and notarized, and payroll setting up. It makes no sense to spend $10,000 on payroll costs and setting up your S corporation just to save $5,000 in self-employment taxes or in taxes in general. Okay, so you got to think about that. Setting up the S corporation or electing that S corporation too early can also, I've seen that be just a mistake. Okay, too early, too costly. Um, Take your time, get the advice of a tax planner, and be strategic. Okay. The fourth thing that I've seen LLC owners make, the mistake that I've seen, is uh, paying themselves too little. Okay. And the IRS really likes to hone in on that when they have an S corporation set up. And in a lot of cases, in my time frame, in my years, I've seen and I'm known that people did not get the best advice because they'll set up an S corporation and not even know that there is a requirement to pay themselves. They don't even know that that they're a stockholder, a shareholder. They don't know that they have to be shareholders meetings. They don't know that they have to be board meetings. They don't know that they have to pay themselves a reasonable salary as the head of that company, whatever position they decide to take. And it gets them in trouble because the IRS, when they audit the S corporation, they look and see, okay, was their salary? And in a lot of cases, when you're just starting out, if you elect that S corporation too soon, but you still try to be in compliance with the law and you pay yourself a little salary, then that can get you in trouble as well. The LLC owners pay themselves too little of a salary, and the IRS hates that, and it's a red flag. Okay. And then the fifth mistake that I see a lot of LLC owners do is they start pulling money from the business and the business operation too soon, too early, too much. Okay. This is a silent killer, like I said, for cash flow. Okay. As long as a business is flowing cash enough to meet their operating needs and their taxes and have cash reserve, then everything's good. But if something pulls at that amount, whatever that amount is, and it puts a strain and it slows the cash flow down. Think about that cash and then flow. Okay. And when the flow is restricted, it puts a strain on the business operations and all other areas of the business that may need to use cash. And if the cash is going out for personal reasons, and there's not enough for business purposes, then the business now starts to struggle. I know, and I've seen it personally. So these are some of the these are the 5 mistakes that I see LLC owners that they make when determining, when to pay themselves, how to pay themselves, how much to pay themselves. Okay. Um, but these mistakes, they can be mitigated. Um, they can be um, reduced with the proper amount of planning. All right, they're totally avoidable with planning, with advice, with coaching, with discipline. Okay, and you know this is part of what the message is that I want to put out there. Okay, um, I'm a proponent for business. Like I said, I'm a business owner, and I've owned businesses that flipped and flopped more than a pancake. And then I've been blessed the last 13 years, have a business that's profitable from day one. And I'm so blessed. And I want to provide knowledge, education, information, inspiration for those of you guys that are going to start a business or in business. I'm here to tell you that being a business owner is not easy, but it is rewarding. Okay, and if you feel like that is part of your your platform and part of what you're destined to do, then I want to be able to help. That's why I give these sessions, this message, and provide information. And I want to just be of value. I want to be a person of influence to you guys as far as giving you advice. Okay. So if you think about the five mistakes that I just said, okay, paying yourself when you feel like it, mixing business and personal accounts, um, S corporation too early, paying yourself too little as a salary for an S corporation, and then paying yourself and pulling money out of the business before it's fully funded. Which one of these do you think is the most biggest mistake out of these five that an LLC owner can make? Let me know in the chat. One, two, three, or five. Which one you think is the biggest mistake? Okay. So now for this session's uh, immutable law or set of principles. Okay. I'll talk about the law of stewardship. Okay. And let me introduce the law the law of stewardship like this. The law of stewardship, as it pertains to our topic tonight, LLC owners paying themselves, the law of stewardship basically says that you don't pay yourself and you don't just take money out the business willy-nilly. Okay. You are responsible for the money and this business. You were blessed and gift to have a business, start the business. You're not the source, you are the resource. And as the resource, if you want to be a good steward, then you have to be very, very um, aware, be very judicious, be very responsible for managing the money that comes through your business. Okay. And the law of stewardship has some I want to call them sub principles or four simple principles within it. Okay. And I want you to think about the law of stewardship and these principles as guides for you in your business. If you're serious about your business, then I want you to let these things be guides. Okay. And some of the principles, there's four principles, there's simple principles within the law of stewardship, but the first one is the business comes first. Okay. You take care of the business expenses, taxes, having a savings account or emergency account before you pay yourself. Okay. Real simple principle. Number two, you keep money separate. Okay. You keep the revenue from the business separate from personal revenues or personal accounts you have. Do not commingle the funds. Okay. They never mix. Um, you pay yourself what's fair. This is the third principle within the law of stewardship. Okay. If you're on payroll, your salary must be reasonable. Do your research, find out what's reasonable according to the IRS guidelines. It may take a little work. Okay. Don't be afraid um, to um, to call on a tax professional or to do your research yourself. Okay. And then the fourth principle, prove it. Okay. By prove it, I mean documentation is key. Okay. And in the IRS eyes, if you don't document it, it did not happen. Okay. So you want to document every draw or distribution as an LLC owner that you take. You want to document your salary. You want to document your distribution and your payment of taxes. Okay. No records or poor records, no defense or poor defense. And what I mean by defense, when and if you are ever called um, to the principal's office, as I call it, or the IRS for an audit and you cannot prove an expense that you claimed as a deduction, then this it's going to be disallowed and it's going to change your whole tax situation for that given year or multiple years because most audits audit multiple years, at least two. Um, and it's going to affect your life and your personal life, and it's definitely affect your tax life. So the 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 law of stewardship and these four principles should be guiding you in some way, or should be in I don't want to say back of mind, but front of mind all the time as you're moving your way through your business. Okay. One thing I learned in business school: businesses have lives. Right? Businesses are born just like humans are born. Okay. They're first born in someone's mind, or in could be in multiple people's minds, and then they're thought of, like gestation period. Then they're born, like birth, and then they're babies, and they start off small, okay, and then the goal is, a human. Most humans will grow. Businesses don't have to grow. It depends on how the business is run, structured, nurtured, okay. But the point I'm making here is that you have to, if you're sincere about your business, if you think your business may be your calling, or you have a passion that drives you to want to do and be your own boss and control some of your destiny, you have to think of your business in the manner of it's alive, it has a life, okay, and you're breathing life into it every day, okay, and the principles or that you adhere to and live by, and the behaviors that you have and the mindset that you have is going to be a big determinant on whether your business flourishes. Okay, and I know this from personal experience. Okay, and I tell you this as a business owner. Okay, and if you have some guiding principles, a mission, a manifesto, a philosophy, and you live by that, or these principles, like the law of stewardship, and take care of the money and the clients, then you're going to be okay. Okay. These principles are timeless. They don't change. No matter what the society says and does, you if you use these principles along with a lot of other things in business, but if you use these as guiding um, principles for how you run your business and operate your business, you're going to be okay. Okay. They just got to be consistent and tax smart about it. All right. So we're talking about how LLC owners pay themselves, right? And I've given you three different ways on how to do that. But how do you really know what's right for your business, okay? And what's right for you? You have options. We talked about flexibility earlier, right? So let me give you a tax smart framework that you could use to help guide you if you're that LLC owner ready to start paying yourself, or deciding when you want to start paying yourself. Okay, how do you decide what's right for you? Well, here's a framework. Here's a an outline for you, if you will, a structure for you, and these things are things that you should consider when you're starting to make that determination. Okay, and it's based on uh, the profit of your business. This framework. Okay, so if your business is making under 40,000 in profit, keep it simple. Okay, just take the owner's draw, the distribution, record it properly, and put money away for business operations first. Okay, but keep it simple, under 40,000 in profit. Right now, if you're making 40,000 to 80,000 in profit, now's the time you need to start evaluating. Hey, is it time to talk to the IRS about changing my classification, maybe electing to be an S corporation? Okay, you start to consider that, you start to explore it, if you will. You talk to a tax professional that is, um, in my opinion, someone that's well versed in business as well as planning, okay? And then you run the numbers, okay? This is where being a business owner is not just being an operator and doing the thing that you do. This is running the numbers, which means knowing what's going on in the back office, where the accounting happens, where the bill are paid, where the invoices are written, where the creditors are calling, you know, run the numbers. Okay, what's going to work for me? Okay, is it time to move my classification to an S-Corp? Okay, and then seek the advice of a professional. Okay, now if your profit is over $80,000, then hey, an S corporation is probably going to be your best bet. You make that election, you get it approved by the IRS, okay, and you probably save once you start implementing payroll thousands and thousands of dollars in self-employment taxes every year. Okay. Now remember, this framework isn't one size fits all. Okay, there are obviously other variables that have to be considered, but this is a framework that gives you and it's based on profit, but it gives you a starting point in your particular decision on how and when and how much to pay yourself as an LLC owner. Okay, and the decisions you make, some of the other variables are going to be the profit we talked about, the goals that you have going forward, your willingness to sacrifice, your willingness to stay organized, whether you have shareholders, whether you have partners. Um, there are so many different variables, and that's where a tax smart, if you will, and a forward thinking and a proactive tax life comes into play because you start thinking, I need some help. I want to plan this thing out right. I want to make sure that the timing is right, the amount is right, the documents are right. Okay. And when you use this framework as a guide, it's going to be very beneficial for you when you decide to pay yourself as an owner in the LLC. Okay, so I'm hoping that this conversation helps somebody. I know it will. Okay, because even in my own practice, I have people that start businesses all the time now because it's most because we have a lot of tax preparation clients. It could be a whole year between the last time I saw them and then the next time I see them, and they tell me, "Oh, I've had a business for a year." Okay, and now we're playing catch up, and so if we would have had that planning relationship, then I would have known and been able to advise them up front on some of these things. So I want to say that the information in tonight's session is going to help somebody, okay? Even if it helps them to make the decision to go talk to somebody, a professional, first to help them get a jump start on the decision on how to pay themselves as an LLC owner, okay? So let's recap this session, all right? And I want to talk about, I'm gonna recap and then I'm gonna have some things I want you guys to do going forward, all right? So LLCs don't automatically um, tell you how to pay yourselves. Okay, they don't tell you anything about how to pay yourselves. Okay, but you do have options, and the point of this session tonight was to tell you you have options. You need to think about your options, and you need to take this decision very seriously. Okay, we talked about the three main ways that an owner can move money and pay themselves. Okay, the owner's draw, the salary, or the S corporation with split income. Okay, between salary and distributions. Okay, we looked at some of the what I call the five biggest mistakes LLC owners make when it comes to paying themselves, and then finally we talked to well not finally then we talked about the law of stewardship, okay, and those four principles that support that law and how that law of stewardship should be one of the guiding tenets of your business, okay? And always front of mind as you make business decisions, okay? And then finally, we walk through a framework that I that's based on profit, but that I gave you that gives you an idea of when you start to make some of these decisions to pay yourself, and it's based on the profitability of your entity. Okay. Um, I hope this session is valuable. I know it's going to be valuable to someone. Okay. And I say that because the information that and the education that I'm disseminating is God breathed. Okay. And I want you to do me a favor right now. Okay. We're just getting started in the the, the online presentation of our vision of tax life. Okay. And our mission is to transform minds of taxpayers and change a taxpayer from going what we call a tax filer, which is someone that is unprepared, ill prepared. Um, they are reactive in their tax life, and our mission is to transform their mindset into a person that is uh, well prepared and well informed and well educated and understands that they can actually use the tax code to their benefit with the proper amount of knowledge and in implementation of the things that they learn, um, and into what we call a tax planner. Okay. And so I want you to do me a favor right now. I don't know a lot of stuff about the likes and the shares and all this thing, but if there's a share button where you are, share this with somebody. Okay. And I know everybody knows somebody that's got a business or a side business. Okay. We all visit businesses every day. Okay. But someone needs this information. Okay. And if you're an LLC owner and you're ready to stop guessing about, okay, when do I pay myself? How much do I pay myself? What are the rules and regulations? What are the guidelines? Okay. And you're ready to start knowing to pay yourself, reach out to us. Okay. Reach out to us. Okay. This is what myself and my team do, on a daily basis. We talk planning. We make plans. We set up businesses. We structure entities, we educate, we resolve tax issues that are a result of bad decisions. Okay. We help LLC owners pay themselves the right way. All right. And save thousands of dollars every year, so they can live the tax life that they want. All right. So remember, paying yourself isn't about money transfer from one account to another. Okay. Not just that. It's about stewardship. It's about leadership. It's about strategy, tax savings, building wealth for the future. Okay. Stay intentional. Stay tax smart. And as usual, I like to say, and I like to ask you to ask yourself. Remember, ask yourself, what's my dream?